Mutual funds sahi hai. Probably this statement has seen tons and tons of new investors coming and investing into the mutual fund market, into the stock market. But we should remember, everything goes in a cycle. Markets too. So if markets goes down, these so-called sahi hai mutual funds would give you negative returns. What do you do? Mutual funds, they invest in the stock market. Now, since they are market linked, these funds, they also get affected by the movements of the market, by the ups and downs of the market. So when the market goes up, these funds, they also perform good. When the market goes down, these funds starts performing badly. They go down as well. They start losing money. What do you do? Now, this is when many investors, they start panicking. They start taking a decision which they shouldn't be taking at all. They start taking a decision in haste. A decision that may not be at their very best interest. If you're an investor and if you're wondering what to do in such a scenario, hold on. I have 7 important steps which you should consider or which you might reconsider doing while you face such a scenario in your investing journey. Well, I'm not questioning your knowledge. You may or may not know what to do. But let me tell you, this video is going to be very, very important for your investing journey. You are standing at the crossroad, absolutely confused which way to go. And if you take the wrong route, you might end up meeting new friends. That's why I say investing is tricky. It's not as easy as it looks like. Every step you take in the financial world is a challenge. And with those challenges comes the next big opportunity. This video will give you an insight, for sure. But the next video I post can bring you that next big opportunity. So like this video and subscribe to this channel right away because you don't want to miss it, do you? See, the first step that you should be doing while you face these scenarios is to stay calm. The stock market, it usually performs well over a very longer period of time. In the short while though, the volatility causes it to drop or get a steep climb, but over a very longer period of time, it remains calm. It gives a directional flow. You might see short instances of negative returns from the market. That might happen while you're investing, while you're into your investing journey. And that happens with every investor. But if you see a long-term history of any mutual fund, any good performing mutual fund, you would see that these short-term 3-4 years dip would bounce back and start giving you positive returns in the future. It has happened every time in the past. Every time. See this data from Crystal Research. As you can see, if you have a longer time horizon of say 7 to 10 years, you need not get disturbed by the news around you and lose your calm. Don't let the noise get you. A study conducted by White Oak Capital on SIPs reveals that the chances of getting negative return completely vanishes if you stay invested for more than 7-8 years. Check this out. The study was done based on the XIRR rolling returns on monthly basis for BSE Sensex TRI for SIP between 1996 to May 2024. During this period, even the minimum returns for SIP is lowest for an investment duration of 3 years at 36.2% or minus 36.2%. It increases to minus 10.5 for an investment horizon of 5 years. This number becomes positive as the duration of investment becomes 8 years at 1.4%. The minimum return increases steadily for longer investment horizons and becomes 4.6%, 6.2, and 7.4% for investments lasting 10, 12, 15 years respectively. Further, the chances of getting over 12% from mutual fund SIP is 69% in 8 years, 79% in 10 years, and 90% in 15 years. Also, the chances of receiving over 8% return becomes 99% for investment horizons over 10 years, while the chances of receiving over 10% returns becomes 95% or higher. So that brings us to point number 2. Avoid redeeming in haste. Can you lose money in falling markets in mutual funds? The answer is yes, you can. But think twice before you start redeeming your money whenever you see a poor performance in a mutual fund. Certain investors believe that they can take their money out of the mutual fund when it's going down, and then they can invest it back at the very bottom when it starts rising again. This sounds good in theory, but more often than not, in practical reality, it doesn't work out. The timing isn't perfect. Nobody gets it right. So what happens, on the other hand, is while trying to do this, people start selling when the prices are low and they start buying when the prices are high. And when that happens, the investing, compounding is hurt, and the long-term wealth creation process takes a hit. And on top of that, you pay 1% exit load and as well as the short-term capital gain tax. That's just insane. So the decision of redemption should not be a factor of the current market conditions. Investing in mutual funds through the SIP route takes care of this hassle completely, because it negates you, because it prevents you from timing the market. It prevents you from getting involved into the activities of selling, premature selling. It prevents you from getting into the activity of taking wrong decisions at the wrong time. And at the same time, it leverages the rupee cost averaging. It helps you to buy more units when the market is at the very bottom and buy less unit when the market is expensive. So it averages out the purchase value. Number 3, compare the fund's performance with the other funds of the same category. If you feel that the funds you have invested in is not performing well, the first check that you can do is try and compare your fund's performance with a similar fund from another AMC or from different other AMCs. Mutual funds are for long-term investments. If you see a little bit poor performance in your mutual fund compared to the other funds from the other AMCs, switching may not be necessary. I understand a couple of % difference makes a big difference over a very long period of time. But if you're getting 24-25% on a particular investment and another fund from another AMC is getting 25%, it's making 1% higher, you might feel tempting to shift your holdings into the fund, but getting 24% is also even very good. Number 4, compare your fund's performance with the other funds from other AMCs and of different category. Now, some mutual fund categories are more volatile, like the small cap funds. They offer more returns, but they also offer more risk and are more volatile. If you feel you're not up for this risk, you can check the performance of other funds from a different category, maybe multi-cap, flexi-cap. If it offers you similar returns to this small cap fund, or maybe 1% less, but if that is more conducive to you, it gives you more peace of mind, you might think of switching it over. Number 5, research the sector. Well, this is only relevant if you have invested in a sectoral fund. Well, even when the market is doing well, it's going up, certain sectors may perform poorly. If certain sector is performing badly, you must research that sector. Sectoral funds are risky because they are much harder to predict than other typical mutual funds. You should be aware of the health and the prospect of that particular industry. If it's going good, if it has a future, probably that sectoral fund would give you better returns. But if it doesn't have a future, if it doesn't have a market, if it doesn't have an acceptance in your country, that particular fund might not give you good results. Diversify. This is very, very important. This is perhaps the only way to counter your mutual fund loss at this moment. If currently your mutual fund portfolio is only exposed to equity, add little gold or some liquid funds to it. Also diversify across asset classes. Diversify your investments into real estate. Put your money into REITs. Put your money into cryptos if you understand that. Buy gold. Buy precious metals. Gold can be an excellent hedge against the falling markets. It's seen usually gold prices, they move up when the market starts falling. And the most important factor is, what do you think? Can you lose money in mutual funds? The answer is yes. Should you have a knee-jerk reaction when there is a volatile market ahead? Probably not. This situation is uncomfortable, definitely, for sure, but it will pass. Markets have bounced back before and they will do so again in the future. Temporary events like elections, geopolitical tensions, recessions, pandemic, this world and this market has seen it all. And it has always moved on and turned back to give us higher returns. It has always thrived. Investing is a long-term game and it should be treated like one. So stay calm, invest with a vision, keep yourself updated, and you're good to go. So this playlist here, it'll tell you what you should be doing next. You can't miss this out. Please go ahead, have a look at it right now. As of this video, adios.